G'day everyone, Dan here from Edge Small Business Consulting. Today I've got Stephen Dionysius from Venro Finance. How you going, Steve?
Good, mate. How are you?
Good, good. Guys,
Great.
today I wanted to bring Steve on just to have a bit of a chat around lending for small business, but also lending for you as the business owner, and get a bit of information around that. So I've got, like usual, I've got three questions I'm going to ask Steve, and Steve will give us some real insight and help with that. Is that all right with you, Steve?
Perfect. Let's crack it on.
All right, perfect. So the first question I had was, in terms of getting a loan, so what key documents and information are lenders looking for when a small business or a small business owner is actually applying for a loan?
Yeah, look, Dan, there's self-employed and small businesses are very important to the economy, obviously, but when it comes to borrowing money, the key things are the bank's going to want to know, can you service it? Have you got enough of a deposit to kick in? And what's the purpose for? So assuming your clients are looking to buy a home to live in, so the purpose is to owner occupied, which is a tick. Then it comes down to what's the deposit like. So clients typically will need a minimum of 5% plus costs and things like that. But that will come with some mortgage insurance. To avoid mortgage insurance, typically you need a 20% deposit. But in terms of the serviceability, what we have found is there has been a shift from a lot of the lenders in relation to how they will demonstrate one's serviceability of a loan. Now, typically you would have the old adage of, we need to have your most recent 2 years tax returns with the notice of assessments that you get from the tax office when you've completed and lodged. But now what we also need to find is banks are wanting to know what their current tax position looks like. So if you have a tax debt when you're applying for a loan, it's very important that your broker or someone who's doing your finance is aware of that, because most lenders will want your tax position to be clear before you submit or gain an approval from a lender. If you do have any tax arrears, there are lenders out there that we can source funding from. But when we're talking about lenders that are non-conforming lenders, we must just remember that that's going to come at a cost. Okay, so if you want a straight self-employed income, 20% deposit, have your 2 years tax returns completed, have your tax portals up to date, liaise with yourself and also your accountants to make sure that when you're applying, all your ducks are in a row.
No, that's really good advice, and all those kind of things really help, and obviously really highlights the importance of keeping all your books up to date continuously. Because if you do come across an opportunity as a small business owner, you can move quickly on that opportunity. The last thing you want to do is find an opportunity to invest and you can't move anywhere because you've got to get things like tax returns or BASs up to date, or accounts for that matter. So now that's really good advice, Steve. So I guess the next question I have is, from a small business owner, what are some of the things, and we've touched on it a little bit, what are some of the things that they can do to really give themselves the best chance of getting a loan from a lender, whether that be, as you mentioned, for a house or even more money into the business? What are some of the things that they can do, to give themselves the best shot?
Yeah. Look, what we've found in recent times, some of your mainstream lenders have introduced different policy niches for self-employed people. So if you've got a client that you're working with who is typically self-employed, but they're paying themselves a regular wage, what we've noticed is some of the banks are actually allowing pay slips from that party to be verified by bank statements. So if you're paying yourself a wage of, I don't know, let's call it $3,000 a week, or $2,000 a week, and it's regular every day, every week going into the bank account, we have got lenders that will assess that from a simple verification process. And what we would probably also need is a letter from the accountant to say that this is, the business is trading profitably, etc. So it's taking away that old, way of assessing one's application of providing 2 years tax returns, etc. So one thing I would say is if your clients are looking at paying themselves a regular wage, don't delay that. If the start of the financial year, you're sitting down with your clients and the strategy is, yep, I'm going to make myself pay a wage every week, that actually will have a good positive outcome for you if you are looking to apply for a loan, because what the banks will want to see is at least 6 months worth of regular credits. So, that's one tip I would say. The other thing is if your clients are GST registered, and they don't pay themselves a regular wage and they haven't got their up-to-date tax returns, it doesn't mean that we can't source funding. It just means that we have to source funding outside the box. And that might be a positive for your clients as well, because we all know the property market has gone up, and we all know that if you want to make a traditional loan where you have 2 years tax return, but if it's going to take you and your accountant a few months to rectify that position, you might also lose the opportunity of buying a property and entering into the market. So what we've done in the past with clients is we haven't steered away from actually pushing that opportunity down the road. We actually can source the funding. Yes, the interest rates are a bit higher. Yes, the fees are a bit higher. But when you work out the long-term plan, getting into that opportunity now as opposed to waiting 6 months when your tax returns are sorted, the fees and the interest rates are kind of irrelevant. But the important thing is, once you've got that plan, your broker or banker can actually work with that plan and then possibly refinance later back to a mainstream lender whereby you can tick the boxes and the checklist that the banks give us.
No, that's really good advice. And I guess it really highlights the importance of working with a broker as opposed potentially to a bank, because I know from my own personal experience and for my business is that obviously I've been working with Steve for quite a few years now, and he has been able to help us with all that kind of stuff. And you've got someone that's in the know that can direct you down these paths. Whereas with a bank, you can get a different person every time. It can be quite challenging. So, no, look, I appreciate that, Steve.
Yeah.
Thank you.
And Dan,
sorry,
sorry, mate. Brokers are, bound by best interest duty for clients. So when you go to direct to your bank, they've only got one product or one service that they can offer. Brokers have to comply with best interest duty. It's a very important part of our business. And, it's not a case of, oh, yeah, this is Bank A, this is who you should use. We have to demonstrate why we use Bank A versus Bank B and Bank C. So that's where a typical small business, if their tax returns aren't up to date, etc., we might be referring to Bank A being, the lender who can look at things outside the box, but then we recommend that bank over Bank B because Bank B, you're not quite there yet. Your position doesn't allow you to go to Bank B, but we will reference the difference in rates and fees. So, yeah, our business is built on following the best interest duty for the client and making sure that clients are fully aware of why we're using that bank. But also the important thing for us is sometimes we have to use a bank as a Band-Aid, and then we rip that Band-Aid off in a year or two when the client's position's a lot better.
Absolutely. No, thanks for that, Steve. So probably the last one, and really, I guess, honing in on what we've spoken about already, is there's, especially for small business that need cash quickly, whether it be from a working capital standpoint or whatever they need it for. Um, I'm talking about lending institutions like your PayPals, your Latitudes, those sort of typically high fee, high interest sort of quick payback loans. What are some of the pros and cons that you've sort of come across in your time in utilizing some of those type of lenders?
Yeah, look, that's a great question, and there's a lot more of those lenders are out there. And and the positives are they give choice and opportunity for clients who do need that cash flow buffer, or they need to find that vehicle, or whatever it ends up being. A lot of those lenders they use tech behind the scenes where, you know, they may not need your tax returns or financials, but what they will do is they'll tap into like a bankstatement.com where it's got an algorithm built in behind it where it'll pretty much work out a profit and loss based on one's spending habits and income coming in and expenses going out. Look, nothing's going to beat the traditional I'll give you bank security by giving you my bricks and mortar. You know, that's getting funding when you're using your bricks and mortar should be the cheapest option because they've got security. But sometimes it's not always the easiest thing because that bricks and mortar might be secured with this bank, but they're not going to give you any more money. So you may need to go and get an unsecured facility with another lender. Now, all of the lenders that we use, you know, there's yes, the interest rate is going to be a lot higher. But as I said to you, like interest rates shouldn't be the main driver for securing your business. I mean, sometimes you've got to pay for the banks will, it all comes down to risk for appetite. So if the bank says it's going to cost you 15%, well, that again would need to be compared to a couple of other lenders, and then you work it out, and it may not be actually that bad when you really break it down. And I think that's where I know that you, with your clients, you have regular catch-ups. You know, you're looking at zero a lot of the time, so you've got to kind of sort of talk with your clients around, okay, why do we need a 30 grand sort of cash flow buffer now? Why is that the case? Is there an issue with expenses? Are you spending too much in different categories? Because there's nowhere to hide these days, Dan. Like, honestly, you just can't hide from anything. So numbers don't lie. The ins and outs are important. But I would also recommend that, you know, with clients like, I know that you have a lot of small business clients, but, you know, when GST is paid, that's not your money, right? So for a small business like myself, one tip that I would give to most people is when you're paid, take that money and put it somewhere else because that money is going to be due at some point in time. And what you want to try and do in that regard is it just creates a behavior and it shows the banks that you're actually thinking about your business. Because where a lot of small businesses can fall into the trap is they have all this income come in one time in the month, and then all of a sudden something else pops up, and that income that's coming in is including GST potentially, and then that money goes out to fund something else. And then when you go to your clients with a BAS, you know, lodgement, and there's this much, and they don't have it, what I've found is just by taking that 10% out, or give yourself a buffer and put 20% away or something like that. It just takes away that added stress when you're sending that BAS every quarter.
No, definitely, Steve. That's really good advice. And further to what you're saying, that whole saving a percentage away, whether it be for tax or employees or other expenses coming up, is really good budgeting and cash flow management. And we'll do another sort of video on that budgeting process in and to itself. So really good advice. One thing I will add there though is as well with those types of lenders where you are paying a very much a premium for the lending. Further to what Steve said, it's about understanding why you're getting the money. Now, are you getting the money because it's something to keep your business running and that will improve your business in the future? Are you getting the money to put a Band-Aid on a solution that may not be rectified, so you've been in the exact same position, except worse off 6 months down the track? So it's not just as simple as going, yep, I need 30 grand right now. It's what is that 30 grand going to achieve, and having that mapped out before you even look at that lending, because you know what, it might be better spent elsewhere. So look, great advice, Steve. I really appreciate your time today, mate. Some really, really good information there. I'll leave all Steve's details in the post and in the notes and everything. So if you have any questions regarding lending, please feel free to reach out. As I said, I can speak from personal experience. I've used the Venro team for quite a few years now. They are fantastic. I recommend them to everyone. So no, look, thank you very much, Steve. And yeah, hope everyone has a great rest of the day. Cheers.
Awesome. Thanks, mate.
Thanks, guys.